Preparing for a financial analyst at CMS Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at CMS Energy? CMS Energy appeals to me because it combines essential infrastructure with a clear need for rigorous financial analysis. I am interested in understanding how operating performance, regulatory decisions, capital investment, and customer affordability affect earnings and cash flow. The company's focus on reliability and cleaner energy also creates meaningful long-term planning challenges. I would bring strong modeling, attention to detail, and clear communication, while developing a deeper understanding of utility regulation and CMS Energy's strategic priorities. While answering, connect your analytical skills to CMS Energy's regulated utility model, Consumers Energy's customer mission, infrastructure investment, energy transition, and the opportunity to support disciplined decisions in a capital-intensive industry. Question 2. What do you know about CMS Energy and Consumers Energy? CMS Energy is the parent company of Consumers Energy, a major Michigan utility serving electric and natural gas customers. Its financial profile is shaped by regulated operations, approved rate recovery, infrastructure spending, fuel costs, weather, and customer demand. Consumers Energy must balance reliability, affordability, safety, and decarbonization. From an analyst's perspective, I would monitor earnings drivers, capital deployment, regulatory outcomes, liquidity, and progress against strategic and operational commitments. Make sure to cover CMS Energy's role as the parent company, Consumers Energy's electric and natural gas utility operations, Michigan concentration, regulated earnings framework, and the importance of reliability, affordability, and sustainability. Question 3. How would you build a financial forecast for a regulated utility? I would begin with operational drivers rather than applying a simple revenue growth rate. I would forecast customers, usage, weather sensitivity, approved rates, fuel recovery, and purchased power, then build operating expenses by major category. Next, I would model depreciation, capital expenditures, rate base growth, financing costs, taxes, and cash flow. I would include base, upside, and downside cases, document assumptions, and reconcile the model to historical results and company guidance. In your answer, talk about customer growth, usage, rates, fuel and purchased power, operating expenses, depreciation, capital expenditures, regulatory lag, financing, scenario analysis, and reconciliation to management guidance. Question 4. Explain how a utility's rate base affects earnings. Rate base is the regulated investment on which a utility is generally allowed to earn an authorized return. When CMS Energy invests in eligible generation, transmission, distribution, or other infrastructure, those assets can increase rate base after regulatory approval. Earnings may rise through the allowed return and associated depreciation recovery, but timing matters because construction can precede rate relief. Therefore, I would analyze rate base growth alongside regulatory lag, financing needs, and cash flow. Be sure to mention invested capital eligible for recovery, authorized return, depreciation, rate cases, construction spending, regulatory approval, and the distinction between rate base growth and immediate cash generation. Question 5. How would you analyze a variance between actual and budgeted operating expenses? I would first validate the data and compare actuals with both budget and prior year. Then I would decompose the variance into volume, price, timing, mix, weather, one-time items, and accounting classification. For example, higher storm restoration costs may be operationally unfavorable but temporary and potentially recoverable. I would identify the controllable portion, update the forecast, quantify the earnings and cash impact, and clearly explain whether the variance changes the full-year outlook. Focus on decomposing the variance into volume, price, timing, mix, weather, one-time items, accounting classification, and controllability, then explain root causes and whether the impact is recurring. Question 6. What financial statements and metrics would you monitor at CMS Energy? I would review earnings, cash flow, and balance sheet trends together. Key metrics include operating revenue, adjusted earnings, EPS, operating expenses, capital expenditures, operating cash flow, free cash flow, debt, liquidity, interest coverage, and equity needs. I would also track customer growth, weather-normalized demand, rate-base investment, outage performance, and regulatory milestones. For utilities, reported results can include non-recurring or weather effects, so I would reconcile generally accepted accounting principles performance to underlying operating trends. Discuss the income statement, balance sheet, cash flow statement, operating metrics, adjusted earnings, EPS, capital expenditures, rate base, debt, liquidity, and regulatory or weather-related items. Question 7. What is the difference between EBITDA, EBIT, net income, and operating cash flow? EBITDA measures earnings before interest, taxes, depreciation, and amortization, while EBIT includes depreciation and amortization. Net income additionally reflects interest, taxes, and below operating items. Operating cash flow starts with net income and adjusts for non-cash charges and working capital movements. For CMS Energy, EBITDA can help compare operating performance, but it should not replace cash flow analysis because utilities require substantial ongoing capital investment and debt service. Make sure to define each measure, explain depreciation, interest, taxes, working capital, and non-cash items, and caution that EBITDA is less informative for capital-intensive utilities without considering required investment. Question 8. How would you evaluate CMS Energy's capital expenditure plan? I would classify spending by reliability, safety, compliance, maintenance, growth, and clean energy transition. For each major project, I would assess expected cost, timing, construction risk, regulatory treatment, financing requirements, rate-base contribution, and customer benefits. I would compare the project's risk-adjusted return with alternatives and test delays or cost overruns. The conclusion should address not only earnings potential, but also reliability, affordability, regulatory support, liquidity, and long-term strategic fit. In your answer, cover project purpose, safety and reliability, regulatory recovery, timing, cost estimates, construction risk, financing, rate-base contribution, customer impact, and return relative to alternatives. Question 9. How do interest rates affect a regulated utility such as CMS Energy? Higher interest rates can increase refinancing costs, reduce earnings through higher interest expense, pressure valuation multiples, and make equity or debt financing more expensive. They may also influence the authorized cost of capital in future rate cases. Some costs can eventually be reflected in customer rates, but recovery timing is not immediate. I would model maturity schedules, variable rate exposure, funding needs, and sensitivity cases while considering affordability and the company's credit objectives. Discuss debt refinancing, interest expense, allowed returns, cost of capital, valuation multiples, customer rates, affordability, and the difference between short-term earnings pressure and long-term regulatory recovery. Question 10. How would you analyze free cash flow for CMS Energy? I would calculate free cash flow as operating cash flow less capital expenditures, while clearly defining whether other investments or asset proceeds are included. For CMS Energy, negative free cash flow may be expected during heavy infrastructure investment, so I would assess funding sources, rate recovery, debt capacity, dividends, and asset monetization. I would separate recurring cash generation from working capital swings and one-time items, then evaluate whether the financing plan is sustainable. Be sure to distinguish operating cash flow from free cash flow, include capital expenditures, working capital, financing needs, regulatory timing, dividend obligations, and the importance of sustainable rather than temporary cash generation. Question 11. What are the main drivers of utility revenue? Utility revenue is driven by customer count, usage, approved rates, customer mix, weather, and recoverable fuel or purchased power costs. Electric and gas demand can respond differently to temperature and economic conditions. Energy efficiency, distributed generation, and changing industrial activity may also affect consumption. I would separate volume and price effects, normalize weather, distinguish base rates from pass-through mechanisms, and identify which movements affect earnings rather than merely revenue. Focus on customer count, usage, weather, approved rates, fuel and purchased power mechanisms, customer mix, economic activity, energy efficiency, distributed generation, and regulatory timing. Question 12. How would you assess the impact of weather on CMS Energy's results? I would compare actual heating and cooling degree days with normal conditions and estimate the effect on electric and gas volumes by customer class. I would then determine whether the impact is favorable or unfavorable for revenue, margin, and earnings, including any regulatory recovery mechanism. Weather can distort quarterly comparisons, so I would present both reported and weather-normalized results. I would also test whether persistent climate or usage changes require a structural forecast adjustment. Mention heating and cooling degree days, electric and gas demand, weather normalization, timing differences, customer mix, regulatory mechanisms, and separating temporary effects from underlying operational performance. Question 13. What is regulatory lag, and why does it matter? Regulatory lag is the period between when a utility incurs costs or makes investments and when approved customer rates reflect them. If CMS Energy invests heavily before recovery, earnings and cash flow can be pressured temporarily, even when the project is economically sound. I would analyze the timing of rate cases, trackers, and construction completion, then model the interim funding requirement. Regulatory lag is central to forecasting because investment growth does not automatically produce immediate earnings. Explain the delay between investment or cost changes and rate recovery, its effects on earnings and cash flow, mitigation through rate cases or riders, and importance for forecasting. Question 14. How would you prepare a monthly management reporting package? I would start by validating source data, mapping accounts consistently, and reconciling totals to the general ledger or approved reporting system. The package would include actual versus budget and prior year, key operating metrics, forecast updates, cash and capital views, and a concise executive summary. I would highlight material drivers, risks, and required actions rather than merely presenting tables. I would also confirm owners and deadlines for resolving significant variances. Cover data integrity, actual versus budget analysis, key performance indicators, executive summary, forecast changes, clear visuals, materiality, ownership of actions, and concise communication of risks. Question 15. Tell me about a time you found an error in a financial model. In a forecasting project, I noticed that projected interest expense was falling despite a larger debt balance. I traced the issue to a formula referencing beginning debt rather than the scheduled average balance. I quantified the impact, corrected the model, informed the reviewer, and added a balance check and debt roll forward validation. The experience reinforced that financial models need independent reasonableness tests, transparent assumptions, and documented review controls, not just formulas that calculate without errors. Make sure to describe the control or review step, error diagnosis, quantified impact, correction, communication, and preventive improvement without blaming another person. Question 16. How would you value CMS Energy? I would use a DCF or dividend-based framework alongside comparable utility multiples. The forecast would reflect rate base growth, allowed returns, operating expenses, capital expenditures, financing, taxes, and sustainable cash generation. I would estimate a utility-appropriate cost of equity and terminal growth, then cross-check implied valuation using earnings, EBITDA, or price-to-book multiples. Sensitivity analysis around rates, regulation, capital spending, and growth would be essential because small assumptions can materially change value. Discuss discounted cash flow, dividend discount or equity-based approaches, peer multiples, regulated utility assumptions, cost of capital, growth, rate base, debt, and sensitivity analysis. Question 17. What makes a DCF for a utility different from a DCF for a technology company? A utility DCF typically benefits from more visible regulated revenues, but it also requires substantial recurring capital investment and carries significant financing needs. Growth is often tied to rate base expansion and approved recovery rather than rapid market share gains. I would therefore model CapEx, depreciation, debt, dividends, rate cases, and regulatory timing in detail. Compared with technology, terminal assumptions, cost of capital, and balance sheet structure may have an even greater influence on valuation. Highlight regulated revenue visibility, capital intensity, depreciation, rate base recovery, stable but moderate growth, leverage, dividends, cost of capital, and regulatory or interest rate sensitivities. Question 18. How would you evaluate a proposed renewable energy investment? I would evaluate expected generation, capacity factor, power prices, project costs, operating expenses, useful life, tax incentives, interconnection, and construction timing. I would assess whether the investment is rate base eligible or supported by a contractual revenue structure, then calculate NPV, IRR, payback, and financing requirements. Sensitivities would include delays, lower generation, curtailment, cost overruns, and power price changes. I would also consider reliability, customer affordability, and the project's strategic decarbonization value. Cover project economics, capacity factor, power prices, tax incentives, interconnection, construction costs, operating life, reliability, regulatory recovery, risk-adjusted returns, and scenario analysis. Question 19. What working capital issues are relevant to a utility? Relevant working capital items include customer receivables, collections, fuel and materials inventories, accounts payable, accrued expenses, and regulatory balances. Weather, billing cycles, fuel prices, customer assistance programs, and seasonal demand can create meaningful movements. I would reconcile changes to operational drivers and distinguish recurring trends from timing effects. Because regulatory assets and liabilities may influence cash recovery over multiple periods, I would analyze them separately from conventional working capital. Mention receivables, collections, weather-driven billing, fuel inventories, payables, regulatory assets and liabilities, seasonality, customer assistance programs, and separating operational from regulatory cash movements. Question 20. How would you explain a financial result to a non-finance executive? I would lead with the conclusion, quantify the impact, and explain the operational cause in plain language. For example, I might say earnings were below plan primarily because storm restoration costs exceeded budget by a specific amount, partly offset by favorable weather. I would distinguish temporary from recurring effects, explain any regulatory recovery, and state the forecast implication. Executives need a decision-useful message, not a spreadsheet walkthrough, so I would finish with recommended actions. Focus on leading with the conclusion, translating accounting into business drivers, quantifying material impacts, avoiding jargon, distinguishing temporary from recurring items, and recommending an action. Question 21. How would you handle conflicting deadlines from multiple stakeholders? I would clarify each request's purpose, deadline, decision impact, and minimum acceptable scope. Then I would rank priorities with my manager, create a visible work plan, and communicate realistic delivery times to stakeholders. If deadlines conflict, I would explain the trade-off early rather than silently missing one. I would protect accuracy for high-impact outputs, provide an interim estimate when useful, and escalate capacity issues with proposed solutions instead of simply reporting a problem. Be sure to mention clarifying urgency and business impact, aligning priorities with managers, communicating trade-offs, protecting quality, using a work plan, and escalating early when necessary. Question 22. What internal controls are important in financial planning and analysis? Important controls include controlled model versions, documented assumptions, restricted access, source data reconciliations, formula checks, review sign-offs, and clear separation between preparation and approval. I would maintain an audit trail for changes and ensure reported figures tie to the general ledger or approved systems. Material variances should have documented explanations and owner confirmation. These controls reduce errors and improve confidence in forecasts, particularly when models support regulatory filings, financing, or executive decisions. Discuss controlled assumptions, version management, reconciliations, access restrictions, review evidence, formula checks, variance explanations, sign-offs, data lineage, and separation of preparation from approval. Question 23. How would you assess CMS Energy's debt and liquidity position? I would review total debt, maturity dates, fixed and floating rate exposure, interest expense, credit facilities, cash balances, operating cash flow, and planned capital expenditures. Key measures would include leverage, interest coverage, liquidity runway, and financing needs under base and downside cases. I would also consider credit ratings and access to capital markets. For a capital-intensive utility, a strong liquidity plan must support investment and dividends without creating excessive refinancing or balance sheet risk. Cover debt maturities, fixed versus floating exposure, interest coverage, leverage, operating cash flow, committed facilities, capital needs, credit ratings, refinancing risk, and downside scenarios. Question 24. A major capital project is delayed and costs are 15% above budget. What would you do? I would first validate the cost and schedule data, then isolate whether the overrun reflects labor, materials, scope changes, permitting, or project controls. I would update the cash flow, depreciation, rate base, and financing forecasts and assess potential regulatory recovery. Next, I would test contingency and downside scenarios, identify mitigation such as renegotiation or reprioritization, and communicate the financial and operational consequences clearly. Escalation should include facts, options, and a recommended action. In your answer, explain validating the facts, isolating causes, updating schedule and cash forecasts, assessing regulatory recovery, testing contingency, escalating governance concerns, and recommending mitigation. Question 25. What would make you an effective financial analyst at CMS Energy? I would combine disciplined analysis with curiosity about how the utility actually operates. My strengths are building organized models, checking assumptions, investigating variances, and translating results into clear recommendations. I would learn the regulatory and operational context quickly, collaborate respectfully with accounting, operations, treasury, and regulatory teams, and maintain high standards for data quality. Most importantly, I would connect financial decisions to reliability, safety, affordability, and sustainable long-term value for CMS Energy's customers and stakeholders. Highlight technical modeling, accounting understanding, curiosity about utility operations, data quality, communication, accountability, collaboration, continuous improvement, and commitment to reliability, safety, and customers. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.